You're staring at a chart. You've mapped the levels, tracked the momentum, and spotted a clean technical setup. But your finger hovers over the mouse. That familiar, nagging doubt creeps in. What if I'm wrong about the market direction? To soothe that anxiety, many retail traders turn to large language models like ChatGPT. They drop in their currency pair and ask a simple, direct question. Is the euro going up or down? This creates a dangerous loop. If you write a leading prompt, effectively telling the machine what you already suspect, the AI simply reflects your own bias back to you. It feels like independent confirmation, but you've effectively engineered your own echo chamber. Professional traders don't want a digital yes man. They use AI as an adversarial interrogator, a tireless research assistant whose sole job is to find the flaws in their logic. If an AI agrees with you too easily, stay suspicious. High-probability trading requires you to actively seek out data that contradicts your initial assumptions to see if your setup can survive the pressure. But before the machine can test your logic, you have to build it. The human is the pilot here, and your initial directional narrative must come from reading the institutional footprints left directly on the price chart. When a clear uptrend breaks below a recent swing low, price action confirms a market structure shift. This is the first evidence that institutional momentum has made a sudden U-turn. Once that shift occurs, we look for entry zones. We target order blocks, the last up candle before a sharp drop, and fair value gaps, which are 3-candle imbalances that act like magnets. Finally, we need a destination. We look for liquidity pools, obvious areas of old lows where stop-loss orders accumulate. Smart money sweeps this liquidity, making it the ultimate destination for our trade. An MSS identifies the turn, an order block provides the entry, and a liquidity pool gives us the target. Together, these elements form a singular, logical hypothesis ready to be stress-tested by the machine. Let's put this to the test. Say you've mapped your chart and formed a strong bearish hypothesis on gold. The technicals look pristine. Instead of asking the AI for a price prediction, you use a specific prompt. You ask it to analyze market sentiment over the last 24 hours, specifically considering recent U.S. Treasury yields and U.S. dollar strength. This leverages the AI's core strength. In seconds, it can synthesize massive amounts of complex data, scanning news reports and central bank statements to extract the prevailing macroeconomic tone. If the AI reveals a dovish central bank and falling yields, factors that typically push gold higher, you have a contradiction. The real-world data is fighting your bearish chart setup, and it's time to step back and preserve your capital. But if the AI summarizes rising yields and a strengthening dollar, known headwinds for non-yielding assets like gold, your technical hypothesis now has fundamental confluence. This multidimensional confirmation process serves as the final filter, turning a standard chart pattern into a verified high-probability trading setup. This is the workflow of the hybrid trader. You are combining your hard-earned human pattern recognition with machine-speed data processing. But you must respect the guardrails. AI models are prone to hallucinations, fabricating facts from thin air. They suffer from temporal data lag, and they cannot read the irrational fear and greed operating in live market sessions. The machine is your co-pilot. It checks the flight plan and the weather reports. You are always in command. You manage the risk, and you pull the trigger. To deploy these verified strategies, you need an environment built for precision. FXNX offers a MISA-regulated MT5 platform designed with tight spreads and ultra-fast execution, giving you the tools required to act on high-conviction analysis. Before you place your next trade, check your bias. Stop asking the AI to agree with you. Dare it to prove you wrong.